better to be more active, right? We've seen this huge drawdown and now a bounce all the way back up. Or is it better to kind of keep your fingers away from the stove and just track the big index?
Look, I mean, in this case, as painful as it was probably better just to stay invested. You know, we had a quick note over the weekend that the entire 17% rally, you could have captured in 60 trading minutes if you had just timed it perfectly. So in that sense, it was very hard to be tactical because you had to be so precise and surgical and right to catch it. And I think that's really what's really frustrated a lot of institutional investors is you rallied so hard off the bottom, but really if you didn't own a few little 15-minute intervals, you just weren't able to take advantage of it. So I think folks were trying to be tactical and trade the headlines. In this case, the degree of difficulty to being right was just really unattainable.
So is stay invested the lesson we learned? Because Ken Griffin was telling Shinali on Monday it would have been better to be in cash.
Look, it depends on your investor type and your holding period, right? You know, I would say long-only investors, your sovereign wealth funds, your pensions, like they were looking for opportunities to engage in the sell-off because they have a holding period that can endure that volatility. As you know from our hedge fund and macro directional investors just don't have the luxury to kind of buy and hold, and unfortunately that made this a really difficult trading environment for them.
Cool. Stuart, great to have you as always. Citi's Stuart Kaiser here talking to us about the stock market, and now Katie's going to take a look.
I'm going to do something special.
Stock market.
I'm going to take a walk and talk here. I want to break down this market and take a look at the breadth. We had very light breadth to the upside yesterday. Still managed to close in the green. Right now, you have the S&P 500 off by about 0.3%, and pretty much an even split when you take a look at what's gaining and what's losing, both to the upside and the downside. Let's look at specific stocks here. It's very much still earnings season, and you can see that in Cisco. This is your biggest contributor to the upside right now. They actually boosted their full year revenue view, which has been a rare sight to see in this earnings season. You also have JP Morgan higher as well. That's the upside. Take a look at the downside. This is why we're lower, and it's because Amazon is off by 2.6%. That is taking 6 points off the index. And then you have United Health's bad week continuing to get worse with that Wall Street Journal report about potential investigations here. You can see United Health down about 16%. And this is broadly what you're going to see if we take a look at the sector view as well. This even split on the sector level. Utilities up in the green right now, real estate and financials as well. A pretty defensive tilt all told. And then you take a look at the downside. We have healthcare, consumer discretionary, and energy off by about 1.4%. Now coming up, we'll talk about CoreWeave, also in the earnings season. Profit missed estimates as it pulls forward its AI spend. We'll give you all the details next. This is Open Interest. All right, it's time now for top calls. Some of the analyst action in focus this morning, and we start with Cisco getting upgraded to a buy over at Wells Fargo on AI optimism. The company boosted its full-year revenue guidance. It also beat on estimates when it reported after the bell yesterday. You add it up together, and shares are higher by about 5%. Next up, we have Pinterest getting upgraded to a buy over at Wolfe Research. The analyst cites improving fundamentals and said that the valuation is highly reasonable, but shares pretty much unchanged right now. And finally, JetBlue getting downgraded over at Raymond James. The firm sees a more balanced risk reward after it was upgraded last month. And Matt, currently the shares are down by more than 5%.
All right, JetBlue then taking a hit today, but I want to swap to tech right now. CoreWeave is bringing forward some spending to meet consumer needs that weighed on earnings in the previous quarter and suggests AI spending could be higher than anticipated. You can see those shares down about 5% now as well. Bloomberg Technology co-host Caroline Hyde has the detail on this stock, which actually has been killing it since the IPO, right? It's up about 60%.
You're right, and maybe that's why I see a bit of profit taking, because I have to say, top line growth, revenue, phenomenal. When you're seeing more than 400% growth, people like that. People like the talk about demand, the OpenAI contract signed, the signaling of another $4 billion contract, which they wouldn't name the buyer, but already Moffett-Nathanson saying, we're assuming it's Alphabet. This is a company that is therefore, though, having to spend to meet that demand. The spend, the CapEx guide of $20 to $23 billion just irks some. More broadly, when this is a highly levered business and already they've just done their IPO, they're going to have to sort of put investors' minds at rest as this CapEx is going to be fulfilled by ultimate demand coming from these players. They're going to be building out, they're going to reap the rewards, but it does dent profit in the here and now, and that's probably why you're seeing shares tick down a little bit. Their forecast for operating income is 140 to 170 million. The market won 190 million. Remember, this is actually still posting losses as a business.
I will point out, and I said this when they IPO'd, I'll say it again, one of the co-founders went to Haverford College, and there's not many of us. It's a very small Quaker school. So you're interviewing the CEO of CoreWeave later.
Is he the guy? Is it a different co-founder?
No, it's a different man, unfortunately.
Not Mike.
I am curious, though, what will you focus on in that interview? When you take a look at these results, you take a look at the sell-side reaction, what sticks out the most to you?
Well, I think we do need to ask him about vindicating the capital expenditure. We want to get a hint on who that ultimate purchaser of the last $4 billion was. I think what's going on in Saudi Arabia is going to be really interesting, though, as well. Remember, the fact that we're seeing more and more promises of generative AI, sophisticated chips being able to go to the UAE and to Saudi Arabia, we understand there's concerns about how much of a controlled environment those data centers are. What does Mike say about that? He's going to be the perfect person to say, look, you can stop China accessing overall the cloud compute or indeed the chips more directly. He's going to have such expertise.
eToro is another recent IPO.
Oh, IPOs are back.
And it's also kind of the new school of financial stocks. What do you make of it?
It's like a social media meets trading app, basically. You can follow people that you want to replicate.
Yeah, you can replicate their strategies.
Exactly, and whether it's in assets of stocks or in crypto. So we've got the founder, the co-CEO coming on a little bit later as well to talk about how they saw, I think, 20 times demand for the shares than they ultimately placed. We're seeing the shares rocket yesterday. Yes, they're pulling back a little bit today, but this is what it means for the rest of the market. eToro, of course, delayed during that ultimate April 2nd onwards anxiety around tariffs, but they came back. We now have Chime, another fintech, which at one point was worth $25 billion when it fundraised back in 2021. Will they be able to come to the market? They're anticipating early June for an IPO. Your friend over at Mountain,
Mark D.
I'm not talking about Ryan. I know you might be met bezies with Ryan Reynolds too. He's the chief creative officer, but they're looking to tap the market, get about $1 billion valuation. We're starting to see this creak open of the IPO market. What's so interesting though is you've been watching CATL over in China.
Cattle, yeah.
This is literally the stereotypical eye of the storm geopolitical company. It is an EV battery maker, supplier to Tesla, but a Chinese company that the Pentagon said overall was in some way related to the military and should be blacklisted. But Bank of America and JP Morgan are on that actual Hong Kong placing. It's going to be the biggest IPO of the year in the world. $4 billion it could raise. And again, demand off the charts. They're even saying, look, we can do Reg S. We don't need you retail US investors. We can avoid some regulatory
Well, it'll be fascinating to see how that one goes. I will say when it comes to eToro and it comes, of course, to CoreWeave. So you had eToro, they were upsized, their IPO. CoreWeave,
opposite.
Which, it was the opposite. They had to downsize. Of course, what did they go public? Early April, the end of March. Feels like the environment has just so drastically shifted when it comes to sentiment around IPOs.
But I also wonder, that was a very idiosyncratic story about generative AI and the demand. Do you remember when they came, we were all still talking about a bubble in AI infrastructure that Alibaba CEO was talking about?
DeepSeek fallout.
All of the Microsoft concerns they were pulling back on their data centers. That's be another key question for Mike and Trader, is like, how much are they seeing Microsoft actually coming back and needing that compute with them? Because they said, look, Microsoft did pull back, but Microsoft in their earnings said, we're still undersupplied here in terms of data centers. So I think that they did have a tough time coming into the market, but as you say, up and to the right ever since, up more than 60%.
All right, Caroline, really looking forward to your program. Caroline Hyde, anchor of Bloomberg Technology. She's going to be speaking to the CEOs of CoreWeave, not the Haverford grad, but the other dude, and the CEO of eToro on Bloomberg Technology today at 11 a.m. Eastern, right after this program.
Now, coming up, a bombshell criminal probe into United Health is crushing the stock and weighing down the entire S&P 500. We'll give you the details next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on what's going on with stocks. 22 minutes into the session, we're looking at red arrows after the solid close, I guess positive close yesterday, and really a solid first three sessions for the S&P 500. So even when we're down 0.5%, we're still at 58.67, which is better than a stick in the eye and still higher than what we saw on April 2nd, on the close on April 2nd. The NASDAQ down about 0.6%, as well as Katie said, we're really waiting for NVIDIA. It's still a couple of weeks until NVIDIA comes out with earnings. NYMEX crude is one we don't always reference here, but off another 2.33%. It's a 61.68, so not at the lows that we've seen this year, but really taking a dive after President Trump said Iran may make a deal. In terms of the stocks, a lot of earnings news here. Cisco, Deere, CoreWeave, and Walmart. Then United Health Group has been a huge weight, especially on the Dow Jones Industrial Average, where it was the heaviest stock on the index. Now the reports that they may be probed by the Department of Justice, really taking another 16% off of the stock, Katie, so a huge hit.
Yeah, let's talk a little bit more about that bombshell report. That coming from the Wall Street Journal, that United Health is under criminal investigation for possible Medicare fraud. Bloomberg U.S. healthcare reporter John Tozzi joins us now. So for their part, United Health said in a statement late Wednesday that the Department of Justice hasn't notified the company about the reported investigation. So there's still a lot of questions out there. But what do we know so far, John?
Yeah, so as you said, the Wall Street Journal reported last night that the company is under investigation for possible criminal Medicare fraud. That would be a new development. We know that there have been investigations on the civil side. There's a long-running civil case around their Medicare Advantage practices. This is an area where we've seen increasing enforcement from the government over the past few years around how insurers bill the Medicare system in their Medicare Advantage plans, which has been a big driver of growth for the industry until recently.
So United Health has said that they have not been notified by the Department of Justice of this supposed criminal investigation, and that they stand by the integrity of their Medicare Advantage program. So just to be clear, the company essentially denies that it's participated in any kind of fraud. But what would Medicare fraud look like? What are these allegations actually about?
Yeah, so the way this business works is that when you sign up for a Medicare Advantage plan from a private insurer, that plan gets a premium from the government to provide your Medicare benefits. So they get a monthly payment for all of your care. And that payment is adjusted based on how sick you are. If you have cancer or diabetes or other conditions, the government pays them more to take care of you because your expected costs will be higher. Now, that system has been the subject of a huge amount of controversy because of the way that insurance companies and medical clinics can record diagnoses.
Right.
You know, they have the incentive to sort of record all the diagnoses they can. They get paid more, and there are cases and allegations involving other companies that they have sort of inflated or exaggerated how sick their patients are to increase their payments. So that's the kind of activity that we are potentially
talking about.
Yeah.
Right. Okay. Although, of course, they deny it, and we want to repeat that. John, thanks very much. I know you're going to continue, probably head back to your desk and hit the phones again, continue to report on this story. John Tozzi there on United Health.
I will just point out that United Health down 48% year to date. You take a look at the sectors year to date, and you can see that reflected because healthcare is now your worst performing sector in the S&P 500. Such a different outlook from where we stood at the beginning of 2025.
Yeah, interesting also because it's a defensive sector. So
right.
Today and yesterday, it really should have been getting gains. When we come back, we're going to talk to Liz Ann Saunders of Charles Schwab. Stay with us here on Open Interest. We are 30 minutes into the trading day, and we're looking at some losses on the benchmark indexes. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Shonali Bassick. And Matt, I think it's telling here that the NASDAQ is actually seeing a bigger drag than the Dow and the S&P, despite United Health, despite Walmart. A lot of things to look through on a single stock basis, but also sentiment turning a little.
Yeah, very good point, especially considering the weight of United Health. I mean, it was such a heavy stock on the Dow, but it's lost 50% of its market value year to date.
We'll talk all about it. But coming up first, we're going to get fresh clues on the consumer. Walmart's earnings beat, but the retail giant warns that tariffs and economic turbulence will lead to price increases.
Meanwhile, billionaire Steve Cohen puts the chances of a recession at about 45% amid a significant slowdown in growth.
And JP Morgan CEO Jamie Dimon also weighed in on the odds of a recession earlier today on Bloomberg.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India. We want you.
Economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Now, hopefully we'll avoid it, but I wouldn't take it off the table at this point.
All right, joining us now is Liz Ann Saunders, Chief Investment Strategist at Charles Schwab. And Liz Ann, we heard a little bit from the president there, and we'll get to him in a moment. But we want to focus first on your expectations, your investors' expectations for the U.S. economy. Obviously, the recession fears were heightened when we had 145% tariffs on China. Those have been lowered significantly. And now I thought we could sound the all clear, but apparently not. What's your view?
Well, I don't see this as an all clear. It's certainly the de-escalation is better than what was in place prior to that. But we have to remember that some of the economic data, the forward-looking nature of it, meant that you were seeing rising recession risk even back as early as the peak in the market in mid-February. So I'm not. This all else equal is better news, the de-escalation, but the uncertainty factor, which is really what has constrained things. It's caused many companies to just withdraw guidance altogether, to pull back on capital spending and other long-term investment plans. I'm not sure the outlook is that much clearer that you start to see an alleviation of what that uncertainty has caused companies to do, particularly with regard to forward guidance and things like long-term investment plans. So, I think a re-rating of recession odds may make sense, but I don't think they've been eliminated to any degree.
We're getting a lot of information, Liz Ann. You think about Walmart warning that prices could be seen by consumers at a higher rate. You also have retail sales barely rising. You have producer price information. What is the current data telling you about the direction of travel, knowing that not everything yet is priced in?
Yeah, it was an interesting batch of data today. I would say it was mixed. Retail sales on the weaker side, particularly control group, which is the component within retail sales that maps directly to GDP. Speaking of mapping, what was also interesting is that the lower than expected PPI today, the embedded components, particularly portfolio management fees, suggest maybe less upward pressure on PCE, because in the aftermath of the CPI data, what you could map from there to PCE suggested we might see actually a little bit of a lift in PCE, kind of going against what the CPI data said. That alleviated a little bit with regard to PPI. But then you had Empire come out today, Philly Fed come out today, and it was interesting. You saw a pickup on the new order side, suggesting that some of that tariff-related, trade war-related front-running is still alive and well, and it's going to take a little while before we get any true clarity on this data. I think what Walmart may be expressing here is that with all the front running that we saw already in terms of getting ahead of tariffs, that built inventories at a fairly low cost basis. And I think the point we're in right now from a consumer-oriented company perspective is this gives them some leeway to experiment with what price increases are likely to be and what can stick. So I think the data is going to continue to be murky, at least for the next month or so.
Are there any red flags on the consumer yet, Liz Ann? I mean, we're always worried about the U.S. consumer, and at the end of the day, the U.S. consumer usually surprises us on the upside. Do you see data like credit card debt or a drawdown in checking accounts or anything like that that gives you pause?
Some of the delinquency data is getting to more troubling levels, so I would keep an eye on that. But I think what really holds the key for the consumer is trends in the labor market. We learned that over the last several years, particularly back in, say, 2022, when we were in a bear market in stocks and recession odds were very, very elevated by virtue of the fact that we had, a 9 handle on CPI, the most aggressive tightening cycle on the part of the Fed in 40 years. But the prior period had allowed a lot of households to shore up their balance sheet. They still had a lot of excess savings. So you were able to ride through that, coupled with the fact that we were in that labor hoarding mindset on the part of companies. So we never got the labor market hit and allowed consumption to stay at healthy levels. That's really key now. It's not just key to ongoing ability for the consumer to hang in there, but also as it relates to Fed policy. Because I think the Fed, in light of their dual mandate, may have a little bit more of an eye on the labor market side of their mandate than the inflation side of their mandate. So it's all wrapped up in this labor market bow. I think it's that data, particularly of the leading variety, that will be the tell. Claims today does not suggest we've got serious problems, but that's what I have my closest eye on.
All right, great to get the intel from you, Liz Ann. Thanks so much for joining us. Liz Ann Saunders there.
Thank you.
Of Charles Schwab. Meanwhile, you saw President Trump there briefly. He is in Abu Dhabi today, continuing his tour of the Middle East. He spoke earlier asking Apple to stop building plants in India. We already heard that sound. Let's get straight out to Anne-Marie Hordern. She's standing by with an assessment of, I guess this trip so far has for the most part been about deals. Why is he bringing Apple into this? What is the concern with Apple right now, Anne-Marie?
Well, the president was talking about India and how India is ready to lower their tariff rates, the president said, effectively to zero. So almost insinuating that what Tim Cook and Apple were doing were taking advantage or about to take advantage of lower tariff rates in India as they move and talk about moving their supply chain and production of iPhones from China to India. And the president said he's having a little bit of a problem with Tim Cook. And he spoke to him. He said, we don't want you making your iPhones in India. We want you to do that in the United States. What's interesting is the president has been flanked by executives throughout this entire trip, from Riyadh to Doha. We saw that this morning. On the side of him was GE Aerospace CEO, as well as the Boeing CEO, and as well now in Abu Dhabi. The individual that's missing is Tim Cook of Apple, and the president also called him out on Tuesday in Riyadh, speaking to investors and these business leaders. He said, Jensen Huang, my friend, I see you. You're in the audience. And he's like, Tim Cook's not here, but you are. So it seems to be the president is having a little bit of frustration right now with Apple and Tim Cook. We've heard his name twice, and that individual is clearly missing on this Middle East tour for the president.
Anne-Marie, something that strikes me is how much business leaders are stealing the show in the middle of this Middle East trip. Presumably, it should have been government officials, that this was really what it came down to, the talks that he's having with people that we're working on trade deals with as well as security deals with. Where does Trump actually stand on India right now? There is a notion that they've offered to remove all tariffs, yet this Apple news is certainly a threat to India, too.
Well, right now, Trump has talked about how there's dozens of trade deals, he says, in the hopper, ready to go. We do know that India was one of the first movers alongside Japan and South Korea to come out and try to find some sort of agreement with the United States. This started very early in the first 100 days of the Trump administration. Right after he was inaugurated, we saw the Prime Minister Modi come to the White House, and that's when those conversations on trade started. So I wouldn't be surprised if India in the next few weeks, as we are still in this 90-day reprieve pause that ends in early July when it comes to those reciprocal tariffs from April 2nd, if India is one of those countries that gets to some sort of agreement, especially as the president on his trip to the Middle East and in Doha is talking about the fact that India is ready to bring their tariffs lower, sounds like they're ripe for a deal.
All right, Anne-Marie, thanks very much. Bloomberg's chief political correspondent, co-host of Bloomberg Surveillance, Anne-Marie Hordern, there on tour with President Trump. We should mention that the president also has said that we are closer to a deal with Iran, and that has driven the price of oil down 2 to 3%, whether you're looking at Brent, whether you're looking at NYMEX. So that's, I think, a developing story that we're going to be watching really closely here.
Yeah, absolutely. And you have to wonder if they'll get to that sweet spot that Goldman is looking at, 40 to 50 bucks. But for now,
sweet spot for some.
Sweet spot
not
for some.
Others.
Yes, exactly. And you have to wonder if it's a recessionary signal underneath the surface as well, or if it'll really start to set off more activity. But let's also get a look at some of the stocks moving under the surface this morning. Boeing higher once again. It's a sweet spot in the market today as well, landing its biggest ever aircraft order from Qatar Airways. This is news extended from yesterday. You're seeing another 1.3% gain today. Walmart, we've been talking about it all morning, 3.4% lower on the day. Of course, Walmart is the giant in the room here.
Yeah,
Matt.
but they had same-store sales that were up. They had earnings that beat, and they're talking about raising prices. It looks like the consumer can handle that. I think it's interesting that they're down 3.5% on this. And then Dick's getting absolutely crushed after almost $2.5 billion acquisition of Foot Locker. They are paying an 86% premium, I think it is, to yesterday's closing price, and investors really punishing them for it.
Yeah, and it's amazing that 86% premium probably reflects what the longer-term price had looked like. But of course, a lot of retailers getting smashed in this market. But coming up, we're going to speak to somebody else who knows a lot about exactly what's going on under the hood in Wall Street. We're going to bring in King Street founder Brian Higgins, why he thinks the biggest risks are now off the table. That's next in the Wall Street feed. This is Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world. Global trade chiefs are gathering in South Korea, and they're trying to get FaceTime with U.S. Trade Representative Jamieson Greer. Greer spoke with China's Vice Commerce Minister Li Changong less than a week after the U.S. and China agreed to temporarily cut tariffs. Bloomberg caught up with Changong at the event.
Minister Lee, how did the talk go with Greer?
Good talks.
What topics did you discuss?
Topics on trade?
Are you going to talk with him tomorrow?
Probably not.
When's the next talk with Greer?
I don't know yet.
Will President Trump and Xi have a meeting?
I don't have any information.
How about a phone call?
I don't have any information.
All right. Other member state trade officials are also expected to seek talks with Greer to try and blunt the impact of Trump's trade policies. Fed Chair Jerome Powell says that policymakers are weighing changes to key parts of the framework that guides their monetary policy decisions, including how they think about shortfalls in U.S. unemployment and approach the inflation target. Powell acknowledged that the current framework was designed at a time of persistently low interest rates and low inflation. Powell made the remarks at a research conference on the Fed's monetary policy framework. Shonali?
And Matt, time now for the Wall Street Beat, because joining us now, King Street founder and managing partner Brian Higgins. King Street has 30 years of experience in investing in credit and manages about $28 billion of assets. And I wanted to start with you with exactly that, the bond market. I wanted to start with you with the 10-year yield, because a lot of people are noticing that this kind of nearly 4.5% level on the 10-year, roughly 5% level on the 30-year, it's sticking. And that is something that you have to imagine the Treasury Secretary is watching quite closely.
For sure. Thanks for having me. Always a pleasure to be here. What's happening is the market is taking this wait-and-see attitude on inflation, on the budget deficit, and it was told that with DOGE, with cost savings, with the tariff income, there would be a reduction of the deficit. And they understand there's $10 trillion to be refinanced, and there's certainly a lot of competition for capital.
Well, that refinancing is what gets me a little bit, because if you have a budget deficit that you're sitting with and the cost of interest alone is looking at a 4.5% 10-year, you've got a problem on your hands.
Well, you have a problem. I mean, it's never a problem. Ultimately, there's always a buyer for U.S. Treasuries. I think what happens is it makes it expensive for everyone else to do business, at the base rate being where it is. It is an attractive time. You are being compensated to be in fixed income. Now, spreads have rebounded since Liberation Day. They've done a round trip, and so you have 350 over for high yield and record tights for both investment grade and high yield. However, and what's that saying to you? It's saying to you, well, risk of recession is 10%. However, if you look at small cap stocks, for example, they're saying risk of recession is 50%. So when we talk about dispersion, it's just dispersion of outcomes, dispersion of assumptions as well. And so that uncertainty, while it has come down, I think part of it is the tail risk has been truncated. It was such a wild, how do you factor in 100% inflation tariffs, which cause inflation and slowdown, to a more moderate level. But again, it's still devil in the details as we are waiting to see what the final, these are back of the envelope or handshake agreements. Trade agreements many times are 2,000 to 3,000 pages long and take a long time to negotiate. And so I think a number of industries are, if you look at soft data versus hard data, there's still a question as to where that comes out. The initial soft data was everyone suspended guidance and said, I have no idea. And so if you poll them today, I think they would have a more constructive view. However, the hard data, we'll see if that follows. So far, it's been strong. Earnings been strong first quarter. Yeah. Defaults are still really low. Credit spreads are low. So CPI was good, but PPI, I think, as they said, they're holding the line but their margins have been impacted. And so you saw Walmart say, hey, wait a minute, we don't know how long we can hold this, which would then impact the consumer, which then filters into the hard data.
Well, and if they don't raise prices too much, it really doesn't matter, right? I mean, the question is how much are they going to have to raise prices at the end of the day? Where are these tariffs going to end up? Do you have any view into that?
I think I'm with everyone else, which is a lot of uncertainty on.
But is 10% really a floor, Ryan? Do you think that's what Scott Besson told Surveillance at the beginning of the week? Is 10% really a floor, for not just for the Chinese, for everybody? Is that where Donald Trump is going to keep tariffs for the remainder of his presidency?
it appears to me the administration is using uncertainty to negotiate. And so I think to say that it's going to be 10%, however, if there are certain outcomes which aren't as they were agreed upon or had hoped for, perhaps they would reserve that right to increase them. Again, I'm not involved in this situation, so this is a very difficult prediction. However, I do think if you say 10% is an assumption, then certainly it'll be a more benign impact on that. However, there's still housing affordability is at 30-year lows. And you think about the durable goods, people are still worrying about the uncertainty there, what impacts. So there's still a lot of inflation on the soft goods, and durable goods and consumer cyclicals are still under pressure, and with higher for longer, as again, as I said, infrastructure, utilities, energy, there's a lot of these CapEx spend that need to be done. So again, that competition for capital keeps the base rate and spreads at a healthy level.
Brian, I'm really curious. I want to bring up what we're seeing in terms of bankruptcies, because you have been seeing not alarming levels here, but a tick higher, particularly in those sectors that you're talking about where the consumer is more impacted.
By the way, I was alarmed about bankruptcies until I saw the longer-term chart.
Yeah, it
now
doesn't
not
look
so much.
historically nuts, but it's never a good thing when you have companies either start to file for Chapter 11 or go back to restructure, which we're starting to see a lot of that happen. So it's not even reflecting all the pain. Where are the cracks forming?
Well, if you look at the broader syndicated loan market, the B- is 28% or something, record levels, and so private credit and the broader syndicated loan market would be our new issue market, where we're going to see opportunities. We do a lot of liability management exercises, so there's opportunities to restructure outside of the bankruptcy context. Bankruptcies have been low because of fiscal and monetary policy have been very easy, and it's been a tailwind. And rates have come down and then have gone up dramatically, but not enough to impact these companies. And there's been money supply has been very abundant, and so enabled. There's not a real problem with getting capital. So there's been record amounts of money raised in the credit markets, for example, and so that's been able to go in and finance all these companies. However, as I said, when it's higher for longer, that does come into effect. The consumer has been doing just fine. However, they're starting to get weaker. We've been talking about this for quite some time. On the lower middle end of the consumer market, that is getting pressure, which is then followed through into bankruptcies. But for the moment, it's still being out of court, which means a lower bankruptcy, more of the out of court. But putting together, that is a higher number, but still lower than the trend.
The translation is, even though companies are not going into bankruptcies, they're still going to credit companies and saying, well, wait a minute, we got some problems
we
here.
have to restructure, or we will go into bankruptcy.
Right?
Yeah, that's, I think, a lot like the hard data, or soft data not translating yet into the hard data, and maybe it will. I have yet to really wrap my head around this Federal Reserve story, but Jay Powell, apparently at a research conference, said they're considering changes to their framework in terms of how they think about shortfalls in employment and their approach to the inflation target. What's your view of the Fed and how they assess things right now?
Well, there's been a lot of criticism by the current administration on the Fed, and I think it's important just to say that over the life, over the last couple decades, there have been a lot of issues that they've navigated well. There's a lot of question as to why had they lowered rates last fall versus not lowering now. I think it's, again, the question of the tariffs. Certainly, I think there's an question on monetary policy from the Treasury's view. Why not extend out duration when they could have? So there's been a lot of second guessing. These are difficult jobs.
But the important question is, what do you think the Fed is going to do now?
My view would be they're going to wait. If you think about rates, where they're going to 4 to 6%, given the data, they're going to have to wait to see how the budget negotiations go with Congress, which reached the debt limit in August. They're going to see how some of these tariff negotiations go. There's a lot of uncertainty, and policy, Fed policy, central bank policy, it's like turning a super tanker. It's not a speedboat. So you can't tack back and forth because it takes a while to go through the system. There's a lot of expectations that are met.
Brian, we're hitting a break. We thank you so much for joining us today. That is King Street founder Brian Higgins. Of course, a complicated moment in the market. This is Bloomberg Open Interest.
Get a quick check on markets right now. S&P 500 just about an hour into the session off 0.2%, and the U.S. 10-year yield coming in just below the danger zone at 449. This is Bloomberg. One of the world's most dangerous sports is making a major advance in safety. It is the first league, Moto America, to use Abbott Labs' rapid blood test for concussion evaluation. It'll be on site for all Moto America races this year. The test is able to identify mild traumatic brain injuries in 15 minutes. Joining us now is Richard Varner, Moto America Chief Financial Officer, and Dr. Carl Price, Moto America's Chief Medical Officer. Gentlemen, great to have you on the program. I obviously am a longtime fan. I've been watching Moto America racing for over a decade now. Let me start by asking you, Doctor, about this test. It's interesting that you guys in motorcycle racing have adopted it first. I would have thought it goes to football or boxing. How important is it for motorcycle racers, for you as a doctor that serves these pilots, to be able to assess whether or not they've had a concussion?
Well, Matt, thank you. It's a pleasure to be here. I have a little bit of a vested interest in this, in that I am a racer. I've had numerous concussions, and concussion is actually a clinical diagnosis until now. It's a constellation of symptoms, and many of those are self-reported. And so it's a fairly subjective diagnosis. this blood test, which measures a couple of different kind of biomarkers in the peripheral blood, is the first bit of objective evidence that we have. And when I first heard about this test, I've known about the biomarkers for a while. Although previously you had to do these in a reference lab, essentially you had to draw blood, spin down the blood, get the serum, and send that off to a lab. And it wasn't very helpful at point of care. Last year in April, the FDA approved Abbott's iStat Alentity device, which is a handheld computer that you basically put a drop of blood on a chip and plug it in the computer, and it spits out the answer in 15 minutes. And it was a result of a private-public partnership between the DoD and Abbott. Bottom line is it measures these biomarkers, and right now it's approved by the FDA. It allows us to determine whether somebody with a concussion, we need to send them for a CT scan or not. So, which is helpful just from a triage standpoint in my situation, but it also has some other uses that I'm using it for in terms of helps me quantify a little bit the degree of concussion. It also lets me, being a writer, I kind of know sometimes that the writers don't really want to know they have a concussion, but I can do the blood test and show them and say, hey, look, you really do have a brain injury and you shouldn't be out there. So it's a real exciting, and it's we're just the first sports organization, motorsports organization, certainly in the world, using this as part of our concussion protocol, because it's a huge game changer.
Yeah, well, and safety is so important. Richard, let me ask you about the improvements that you've been able to make. Obviously, motorcycle racing can be dangerous. Your CEO, Wayne Rainey, had a horrific accident in the Misano Grand Prix in 1993. And people don't want to see that, right? As you make these kind of safety improvements, how helpful is that, to attracting viewers, longtime viewers for the sport?
Well, thank you very much, Matt. I think not only is it important to attracting viewers, but also participants. We feel like the future of motorcycle racing is in our youth. And as they grow, we want the parents and everyone around them to feel comfortable that we're taking every opportunity possible to keep the riders safe and to have on hand the ability to determine if they're injured, truly injured, or if they're safe to go. Because it's not only the rider that we're concerned about, it's the riders around him or her. And I think it's a testament to Abbott Labs that's developed this and are putting it out here in our field to make sure it works and well tested.
Dr. Price, could you give us some information also on what you're solving here? What are some of the numbers that you're looking at when it comes to the accidents that you're seeing in the sport, and how much doing this could save lives, frankly, if not at least careers?
Good question. Can you quantify it?
Well, I think that, concussion is a big part of our sport. And on any given weekend, race weekend, we'll have 2 or 3 concussed riders. And once again, this helps us manage those concussions and potentially let us perhaps diagnose them a little more accurately and have some more rational return to sport decisions too. That's always the difficult part when someone after a concussion, when they were able to return to sport, because obviously one concussion, multiple concussions is bad. And we want to make sure that our riders have a life when they get done with this. And so, I think it really does help us be a little more sensitive in terms of our ability to diagnose and manage those concussions. I'll just kind of say it's a real gratifying to be a part of an organization that Richard's put together that really is interested in rider safety. Not only are we doing the concussion testing, we have airbag suits that we've instituted, Road Racing World Air Fence at the tracks, which are barriers to help prevent injury. So we're doing a lot of things to kind of prevent injury, as well as managing injuries like with this concussion test.
Richard, I want to ask about the diversity that you've brought into motorcycle racing, and I don't mean in terms of your typical DEI thing, but the actual bikes, right? We've got a Super Hooligans class at Moto America, which I absolutely love, and then King of the Baggers has been a massive success. I was lucky enough to get to ride Harleys with James Rispoli and the Wyman brothers in Austin a couple of months ago, and I'll never forget it. how much more can you expand with these racing classes? And will you continue to have King of the Baggers as Harley goes off to ride with MotoGP next year?
Well, let me answer the last question first. Yes, we will continue to have King of the Baggers. As you may have noticed, Harley's endeavor in Europe will be strictly a Harley-Davidson class. There won't be any other makes. So we race both Harleys and Indians and feel it's important to have multiple makes in our championship. In terms of, expanding the offerings that we have on the track, our biggest issue is we provide 5 or 6 classes a weekend of racing. So it's very difficult to manage the time over a weekend to get a whole lot more classes in. So we have to be very careful. But we've seen huge growth in the hooligan class, and we're seeing very strong showings in the bagger class as well. So I would say, and stock 1000 is very large. So I would say that as long as we continue to attract those people, we'll continue to run them.
All right, Richard, thanks so much for joining us. Richard Varner there, and Dr. Carl Price of Moto America. Great to see Laura's Baz riding on those baggers as well. I'm sure it's all Greek to you, but to me, seeing these World Superbike and MotoGP guys start to ride big Harley baggers is just super exciting.
I mean, I'll be honest with you. I think it's very, very cool. The reason I'm nervous about baggers is because I still have a scar on my ankle from a dirt bike accident when I was 15. So, we're gonna stay off the baggers for me. But
at least stay off a road glide. Yeah, for sure.
Exactly. Anyways, we're gonna check on these markets, Matt. What are we taking a look at?
Yeah, we are looking at an S&P 500 that is slightly lower, but we've had a pretty good week, right? I mean, Monday we were up 3.25%. Then 0.75% on Tuesday. We're still at 58.69, so not above that 5,900 level that we bounced off of yesterday, but much higher than we were at the close on April 2nd.
Absolutely. And we're at near that danger zone on the bond market as well, as we've been talking about. But I want to look at some single stocks under the hood right now. We're looking at United Health. It is lower following a report from the Wall Street Journal that the company is under criminal investigation for Medicare fraud. You're seeing United Health down more than 17.7%, and it has been a brutal year for the company, as we know. But watching Cisco, that's a brighter story, up more than 6%, rising after boosting its full-year revenue guidance. So business spending holding in strong. That AI story starting to shine a little bit. And Dick's Sporting Goods falling after announcing it will be buying Foot Locker for $2.4 billion. But Dick's down almost 15%. But love a good M&A story. For that story, we're going to bring in Bloomberg's deals reporter Fareed Salul. Now, I was taking a look at the one-year chart of Foot Locker to see, how expensive is this deal really? And that $24 a share is actually $2 above the one-year average. So it's not just a more than 80% premium. It's actually more expensive than the average trade all year.
Yeah, so, look, shoe M&A is pretty hot right now, right? We had Skechers last week.
True.
$9 billion deal. We've now got $2.4 billion being paid by Dick's for Foot Locker. At first blush, this looks like it might be a tariff-related play, right? Both companies sell brands like Nike and Adidas. They have big manufacturing hubs in China and Vietnam, and so anything that can help them weather that storm is great. But of course, the truth is the American consumer was spending less even before Liberation Day, and both companies have been looking for ways to kind of boost sales. This deal will give Dick's Sporting Goods more presence in the malls over here in America and a bigger international presence. So, apologies for the pun, but if the shoe fits,
yes,
and it does fit. So, yeah.
Oh, yeah, that's pretty good. That's pretty good. I like that pun.
I'll take it.
We were actually looking for other shoe sellers on our morning meeting, right? The finish line already got taken out. You mentioned Skechers was taken private.
Yeah.
I'm not sure about designer shoe wear, if DSW is a target.
Well, I'm not sure about that. I mean, most sectors at the moment, retail included, we're watching for signs for any kind of rebound in M&A, right? The market has dried up this year, despite what bankers will tell you about there always being the right conditions for M&A is available for the right deal. but it's been pretty lackluster. We have seen some signs of encouragement recently. This deal included last week, as I mentioned, Skechers. We had Sunoco Parkland. So I think whether it's in retail, whether it's in energy, whatever, people will be looking for a continuation of that.
It's interesting. In addition to M&A, while we have you, the IPO market has been a pretty interesting thing to watch lately. I'm wondering, you see the Dick's reaction, a brutal sell-off on the heels of this deal.
No pun intended.
Oh, God. Okay, I didn't even do that on purpose. But, do you see more likelihood for IPOs if investors are not necessarily rewarding buyers to go out and spend a few $billion right now?
Yeah, so this is the other the big half of the deal-making market, right? What's happening in equities? Like M&A, it ground to a halt after Liberation Day. Lots of deals were pulled. One of them was eToro, for example, the trading platform. That's come back. MNTN, the TV ad company, that's come back as well this week. And
we have to always say Ryan Reynolds.
Ryan Reynolds, exactly. Yeah, he's always the kind of the first thing that comes to your mind when you think of.
He actually did. Did you see his little commercial for the Mountain IPO?
I didn't know. Most of my kind of Ryan Reynolds exposure is through Wrexham Football Club, which I'm a big football fan, so that's where I.
Fair enough. Well, I noticed on Twitter this morning that he's made like an ad for Mountain shares. So he says like, "Oh, we saw this business, knew we had to get involved. Now you have a chance, right?
Okay, well,
shilling the shares."
Yeah.
Well, that's a new way to roadshow,
right?
Yeah.
Well, he's doing it with MNTN as well, and we've got a couple of other stocks now that we're going to be keeping an eye on now that the IPO market looks like it's reopening. Klarna being one, StubHub, Medline. So after what was a pretty catastrophic April for deal makers across M&A and IPOs, we're looking a little healthier going into the spring, and they'll be trying to get deals done before the summer.
Yeah, that's the reality, Matt. You look at eToro, CoreWeave's, tough day today, but generally really good after the IPO. Deal makers inside of, let's say, Blackstone, where you're looking at a massive asset like Medline, are very excited to look at these trades.
Yeah, it's great to see an exit for those businesses, right? And at the same time, they have some entries as well with the increase in bankruptcies or restructures. Fareed, thanks so much for joining us. Fareed Salil from our deals team talking about the M&A we've seen today. Coming up, an exclusive interview with the CEO of JP Morgan, Jamie Dimon, says a recession is not off the table. This is Bloomberg Open Interest.